So this disclosure just gave Chinese tech investors an erection. During the quarter that ended June 30th, 2024, Alibaba actually repurchased 2.3% of its outstanding shares for a total of $5.8 billion US. At least in the calendar year 2024, they have allocated more than $10 billion US in buybacks and retired nearly 5% of the entire market capitalization, netting off share-based compensation in the past 6 months or so. So if they wiped out 5% of the shares outstanding in 2 quarters, 1 year doesn't mean that they'll wipe out 10%. In 10 years, they'll be rebuying the entire company. So hold your horses, my friend. So I think it's exciting to extrapolate the numbers out from here, but these are the facts. Baba still has around $26.1 billion authorized for their share repurchase program, effective through March of 2027. And based on rough calculations, that is at least 11 quarters from here. So if we were to just do a simple division, that means it's roughly 2.36 billion per quarter. And that's less than half of what they did in the last 2 quarters, which is 4.8 and 5.8 billion respectively. So how would things play out from here? I guess time will tell. But here's what we know for sure. In the March quarter of 2024, they've disclosed a net cash position of $61 billion US. And over the past 3 to 5 years, they've produced roughly $20 to $30 billion in free cash flow per year. Their market cap has been stagnating and trading between the range of $180 to $200 billion. So from my observation, sustaining this level of buyback shouldn't be an issue. Furthermore, let's not forget that Baba still has to maintain its dividend policy at roughly $1 per American depository share. So they could potentially increase the limit of their buyback program down the line, announce a series of special dividend, or grow their dividend payout from here. Who knows? Regardless, investors welcome all of it. On that same note, not long after, Tencent also announced that they repurchased over 52.3 billion Hong Kong dollars worth of shares, surpassing the total repurchase amount of 49.4 billion for the entire of 2023. So for context, Tencent is valued at roughly 3.5 trillion Hong Kong dollars, and that 52 billion Hong Kong dollars represent roughly a 1 to 1.5% share reduction. Not as aggressive as Alibaba, but still heading in the right direction, if we were to look at the longer term trend of share reduction and share repurchases. And do you know what needs to be in the right direction too? The growth curve of the like button on this video. So please help bless the like button by clicking on it now. And for those of you interested in getting more updates on the markets and my thoughts in general, do join my newsletter in the link below. And through that newsletter, I'll mainly share 3 things. Number 1, resources that I've benefited from. Number 2, opportunities that caught my attention. And number 3, updates on my portfolio moves. Probably much more timelier than my YouTube videos. So link is down below. Now back to the video. So let's first explore what and why companies do share buybacks. Simply put, a stock buyback program is when a public company uses cash from their balance sheet to buy shares of its own stock on the open market. The main reason for doing so, like most investment bankers like to say, maximize shareholders' value, basically rewarding you for holding on to their stock. So when corporations have extra cash on their hand, there are essentially 5 choices. Number 1, they can spend or reinvest it into their business. Number 2, they can acquire another company or expand a particular business unit. Number 3, they can issue a cash dividend. Number 4, they can repurchase their shares, which is a stock buyback. Or number 5, they can do nothing and keep it on their balance sheet. So like a dividend, a stock buyback is a way to return capital to shareholders. So what's the main difference between the two then? Simply put, dividends are a very direct form of compensating shareholders because you directly receive the cash payments either to your brokerage account or to your bank account immediately. It's particularly important, especially for those that require a regular income from their stock portfolio. And the timing and execution of this so-called dividend policy or dividend payout is not necessarily very important because when the dividend is being paid out to shareholders, the stock price will typically decrease by the same amount or same quantum. On the flip side, share buybacks have an indirect value return, because they do not provide an immediate cash output to shareholders. But instead, they increase the value of remaining shares by reducing the outstanding supply. So it essentially helps boost the earnings per share, as the denominator, which is the earnings divided by the number of shares for that calculation is being reduced. So the timing of the share buyback is also particularly important, because you only want to buy your stocks when it's undervalued. No point buying your stocks when it's overvalued, because it's not accretive to shareholders. So you can overpay for your own stock too. And because of this uncertainty, management sometimes miscalculates and buy back a lot of shares when the share price is high, but actually only buys back few shares when the stock price is low, leading to an inefficient use of capital. Now, just a short interruption. I'll need your help, and your opinions are greatly appreciated. So do help me fill out a survey in the link below so that I can know more about you and what topics you'd like to see me cover in the near future. So if you do complete the survey by the end of July, I'll reach out to 3 random participants with coffee via an e-gift. Thank you in advance. So with share buybacks, on top of boosting their bottom line earnings per share, they also tend to signal confidence to the market about management's expectations of the company. So as the saying goes, you sell a stock for 101 reasons, but you only buy them for one, because you expect the share price to appreciate. So it creates a level of support, i.e. demand for your shares, and it should theoretically also increase the share price due to supply and demand forces. That said, a point to note is that share buybacks has no guarantees. Case in point with Alibaba as a case study. So over the past 2 years, Alibaba has managed to reduce their shares outstanding by roughly 10% or so. But the share price has continued to depreciate by another 10% in that same timeline or same time period. So despite the company's efforts to prop up the demand of their own shares, it was still not enough to combat the immense selling pressure coming from other existing investors, or even the power of short sellers. There are, however, multiple successful case studies where enterprises and shareholders, by extension, enjoyed the power of buybacks. And 2 classic ones are Apple and AutoZone. So Apple initiated a massive buyback program back in 2012, initially committing to $10 billion, and have since expanded this share buyback program significantly, with the latest one in 2024, authorizing $110 billion. And over the last 12 years, they've diligently retired 3 to 5% of their outstanding shares every single quarter. AutoZone is even more hardcore than Apple, where they've repurchased more than 85% of its shares since inception of its buyback program. And their share price have since appreciated tremendously over the years. If you haven't noticed, it tends to be the matured companies that return capital to shareholders through a dividend or even a share buyback. Why, you might ask? Because they are basically saying that, hey, I have limited growth or limited investment opportunities that earn me a high return on investment. That's why I'm basically just giving you back the money to manage it yourself. So the key takeaway from these 2 examples, Apple and AutoZone, are not really the buyback per se, but more so how they've been able to continue buying back shares, yet at the same time grow their core business and earnings power by extension, which is then used to fuel more buybacks and benefiting the shareholder. Now, pivoting back to Chinese tech. So we have seen over the past few quarters that many of these cash-rich companies are stepping up on both the buybacks and giving out rounds of special dividends. So don't be mistaken, it's not just Alibaba or Tencent or some of the big names that you have seen. Just last week, Douyu, who's a gaming-centric live streaming platform, actually declared a special dividend of $9.76 per share. So want to take a guess of Douyu's share price pre-announcement? Was it $90? That's a 10% in dividend yield? No, it was actually $12.60 per share. Yup, $12.60. And they're giving a $9.76 per share dividend. That's basically 77% of the share price as a one-off special dividend. Immediately after the announcement, Douyu actually gapped up 40% to over $17 per share. But the share price increase still does not account for the total special dividend being offered. The icing on the cake, Douyu is still trading below net cash after this special dividend is issued. The market is basically discounting Douyu's entire business, writing it off to zero, and I presume that the market is expecting them to squander the money on their balance sheet away, therefore ascribing a market cap lower than their current cash position. Or, in the worst case, they might even be skeptical of the cash position that they have, and it might all just be fugazi. Right now, excluding some special few, Chinese companies in general are being written off as an aggregate, which gives the companies a unique opportunity to buy back their own shares at dirt cheap valuations. So when looking at the general atmosphere of how the retail crowd is interacting with Chinese stocks in general, there is a growing level of mistrust and skepticism, which exacerbated the selling pressure and created a valuation race to the bottom. You'll probably also observe that the short China equities is one of the more popular trade ideas amongst many players in the markets today, albeit slowing down in interest due to their inconceivable value today. And a large part of many of these special dividend payout is to just signal and to quell some of these concerns by investors being skeptical of their cash position. All things considered, let's not forget that the stock market in the short term is an auction-based system, and for now, because nobody wants to touch Chinese stocks, their valuations remain low, and it provides a good opportunity for the companies to buy themselves back at a very cheap price. The main important factor, however, as alluded previously, is whether these companies you own can bounce back from the lackluster performance over the past 3 years. And with that, I'll see you guys in the next video, but more importantly, I'll finally see you guys on the moon. Goodbye!